Hello, guys. Good to see you guys again. Um,
Hey,
Welcome to today's live. Today, we're going to be talking about the equities all-time high and if crypto will follow. My name is Yann Allemann, and I'm joined by Willy Woo and Henrik Zeberg. Before we start, I just want to give a quick disclaimer to note that this webinar does not constitute financial advice. That's discussed reflects only our personal opinions at the topic at hand. Always conduct your own research and consult professionals before making any financial decision. Participation is voluntary and information provided is indeed intended for educational and discussion purposes only. Let's maybe kick it off with you, Henrik. How are you seeing things on the macro side?
I can't remember when we had the last, was that in late November or something like that? I think it was
Yeah, it was
November.
in
Did we
end
have
of
to?
November, early December, something like that. Yeah.
All right, yeah, okay. So now we've seen the non-farm payrolls developing again. And if we look to that, and I'm sure many of you guys here have seen the non-farm payroll chart that I have been showing quite a few times. And I can just, if you can just bear with me for just 1 second here, because it is quite important. If I've opened that, I opened something else. But if we look to the non-farm payrolls, which is the real economy, this is what we have to understand. It's not all the chit chat about, what did we hear in the financial world. The real economy is people having a job and also having a house. By the way, we talked about housing, the real estate market, the housing market has really been slumping for quite a while, just like in 2005 to seven, where also Michael Burry very famously, were very bearish on the economy. He saw then the housing market actually, developing as he expected, but it just takes a while before it impacts the real economy. But that is what we see now, and so the housing market's been slumping for quite some time. This is the non-farm payrolls, and what is important there is that to see that there are cyclicalities to it. We have to, just admit that there is that. This is not perfect. It's not, perfect sinus curve here. That's not what we see, but there is cyclicality to it. And when you get to a certain point, when it declines, that is when the economy starts to feed on itself, meaning that there comes a negative feedback loop. People are getting afraid of losing their jobs or not being able to find a job, and then they hold back. They don't buy as much. Then the businesses don't need as many people, and you can see right now the capacity of utilization is just in the gutter. Then businesses are holding back and not hiring in so many people, and that's what we see right here. That is the non-farm payrolls, and we can see how that when we talked last, we didn't have the numbers from November or December, and I suggested and said that these could be bad. They are actually bad. 56 and 50,000 is not good. I just want to come back to that, especially because these are the initial print. But what we also have seen since is that actually October was a minus 173,000 now. Minus 173,000. It's unprecedented. We have never seen anything like that unless we are heading into something really bad. So, and then you look at the 12-month moving average here. And if you look to that, it looks even worse. And this is why I saw the Martina Booth or whatever her name is, also the former Fed, also for a year at least, I can't remember her role there. But if you look at the non-farm payrolls here, you can see that the average here is simply below any time we entered a recession, going all the way back to the 1970s. Here, the dotted line is where we are at right now. And you can see that every time we get into a gray area here, we have a recession. And this shows us that the job creation right now is worse than going into any recession all the way back to the 1970s, the last 50 years back. And this, by the way, is in an economy that is much, much bigger than we have seen going back here. These are nominal numbers. This is a terrible job market in the US at this point here. The only thing that is standing in the way is that businesses are not yet laying people off. And there can be many reasons for that. They can be afraid that they won't be able to find the right people again if demands pick up. But guess what? The capacity utilization in a manufacturing and elsewhere is down at around 75%. So why would you as a business right now say, well, I need to hire in a lot of people here? You don't. And this is also where the AI comes and bite our tail here. I mean, because we are, or our assets, because we are in a situation where if you had to hire some people, and you'll be looking at yourself and saying, do I need one or two guys? I probably just want to go with one. So AI is good and it will be fantastic in a long time frame, but right now it's actually also keeping the hiring at a low pace. That is a problem. I know people say, yeah, but then AI takes over and then that's the reason. No, it's not. You need the economy to generate jobs. That is how it is. And if we look to it we can look at it also unemployment in terms of population and say how many, instead of just looking at it from a labor force perspective, because the labor force has also to do with the participation rate, we can actually see that if we go back in time and look at these rounding bottoms here and say, well, we are now past the ratio of unemployment population ratio that we saw in 2001, which was here, and the economy entered a recession there. We're not really at the level yet where we had the 2007 and 9 recession, but we are somewhat below this as well. So the development we have here, this is the difference between saying the economy is deteriorating and the economy is in a recession. That the difference is we're not running backwards just yet, but we are closing in on that time on this, and that's the situation in the real economy. But that is not the same as saying that the stock market is going to crash right now and right here. On the contrary, because right now you can actually have a strengthening job market is when you are in this phase here, because the anticipation of liquidity makes Wall Street go nuts, makes the market go nuts. And that is what we see. And if you look to some of the health indicators of the economy. Here we have the breadth, the market breadth, and the number of percentage of stocks above 200 daily moving average. You can see that that is actually strengthening right now. There's not a lot of weakness to be seen in this. Again, that is not what we would expect if we were standing right in front of a crash. So you can have this, story of two tales here, where you have the real economy, which is deteriorating, which we also saw for quite some time from 2006. Burry was already on it in 2005. From 6 until 7, end of in December there in 2007, before the recession set in. And then you had the people really realizing it when we got into 2008. We are not there yet where the recession is here, because simply there are too many of the indicators that tells us that we are not at a point where the economy is in a full-blown recession. And we are in a setup where it seems like liquidity, this is the high yield corporate bond ETF also suggesting that it wants to move higher, just like what we saw here with the 200 daily moving average in breadth terms. And if we look to some of the most important indices here, which is the Singapore index, and I saw there were, I think, records here from Singapore also and others, that we see that this is moving higher. And that is important, because if you see that these small economies, open economies, and especially one like the Singaporean economy that is so dependent on trade and it still moves higher, then we're not at a top. So this suggests, and this is where we have the wave 4 move, as we can see here. We're starting that wave 4, which is, by the way, also what we see in a lot of other places, like, for instance, in Bitcoin, as I've said all along. Bitcoin is in a phase, as I see it, and this is what we need to discuss also, in a wave 4, where it's been coming out of that, just like what we have seen before. It has a long turn before it then starts to move up. In my model, we are at this phase here, which should take us up very, very fast. When? I don't know when, but I'd say the direction is up. I say a new all-time high, and I say that if we look to the Bitcoin dominance, it's still hanging around there in for dear life. I say it's going to plunge at sometimes. It's taking forever to go sideways, but I think it's going to decline very sharply. And the same with this one, the Ethereum Bitcoin ratio. We see how that has been pushing higher in terms of momentum here, clearly consolidating here, and I expect it to move up higher. What am I saying? I'm saying we have an economy that is still deteriorating, which it can do for quite some time. People will have all fancy ideas of why it's not, and you've seen all the liquidities thing that it's because they are cutting rates and so on. No, the economy is deteriorating, like we saw in 5 to 7, actually. And then all of a sudden we see the shit hits the fan. That's last phase here, because we are in the final push of this massive bull market we have had for such a long time, can go to extreme highs. And I have to say, I'd say at least 8,200 on the S&P 500 now. And Bitcoin, yes, all-time highs, and a fantastic rally in altcoins as well. I see the total stock crypto market reaching around 7.5 trillion, which will mean an extreme move into this first few months of 26.
What about you, Willy? How are you seeing the liquidity picture on your side? We could start, Willy, with the tweet that you sent out a couple of days back, right? Which I think a lot of people have reached out to me as well personally, asking, basically confirming that you changed at least your short-term view, which I think seemed to be the case, right? It was a little bit more positive than the December outlook that you had.
Yeah, the long-term view hasn't changed. The short-term view is always, when we're talking about short-term, I'd say the next 2 months is informed by changes in local investment flows. So if we want to go so I've said I was bullish late January through to February. But I'm still bearish over 2026, and that's a data-informed opinion, which I can get into here with the models. So what we're saying here is the investor flows have put in a bottom on Christmas Eve, and it's steadily strengthened. And then it usually takes around 2 to 3 weeks for that to express itself onto the price domain. And you could say that is sort of happening now, getting an ascending triangle, and it is held back by overbuying on the local oscillators. So we're seeing this consolidation at a very local level. And then I can go into the charts actually, and just talk to this tweet. Actually, I think that would be best. So what we're actually, I will get to this is really this here, December 24th, is where we're seeing a bottom in the flows. These are the flows that are measured that are coming into Bitcoin. So no matter what happens with the picture that Henrik paints on equities, and the global macro scene, what we're interested in is how much of that liquidity, investor capital, was actually flowing into Bitcoin. And we did put in a bottom here. And in the past times, that bottom formed, and then we had strengthening flows coming in from investors, and about 2 to 3 weeks later, price eventually responds. And so it is a leading indicator. What has been interesting about it is that the flows have been pretty choppy here, very indecisive, unlike these very clean V-shaped bottoms. So that gave me a bit of concern as whether this would resolve upwards or whether it would break down. If that had broken down, I would have said that would be heading into a bear market confirmation. So if I put in the leading indicator, you can see how clean the bounces were, and here it's still a little bit messy. So, but nevertheless, it is breaking up to the upside enough for me to say that this is a recovery in flows. And we're looking at this picture across the long term. This is not a great picture because we're actually seeing a breakdown in investor flows coming into Bitcoin. You want to see these peaks getting higher and higher as you enter a bull market. And then once it starts breaking down lower and lower, you're seeing that there's structural weakness in the bull market. So I could take us to this view here, which is a longer term view of the same liquidity, and you can see that we are forming this hump here. And so that has been given me a longer term bearish picture, particularly into 2026. And for me to change my opinion over the longer term, like say second, third, fourth quarter of 2026, is to see the liquidity, the flows coming in to break this downtrend. I would need to see these flows get higher than here, potentially higher than here, until we get to here. Then I would say, yes, it's supported by investor liquidity. The last cycle, you could see that we kind of went a little bit higher and then the whole thing fell apart. Okay, that's the situation. There's some supporting evidence here also, looking at the futures markets, that the liquidity has been dropping away effectively since 10th of October when we had this massive liquidation event, mainly in crypto, but it's been felt in Bitcoin with this liquidity drop away. And you can see right now it is recovering. The second pump of the last cycle was actually very much driven by the paper markets coming and recovering, and we're starting to see that. So I do have hope that we can break this 100K resistance and then contest the all-time high. I'm not sure if we'll break it, but we really need to see how the liquidity comes in. If this liquidity starts to really ramp up higher, then sure, we can break all-time highs and see how far we can go. But I do believe that the clock is ticking. In our newsletter, we have gone to this chart, which is a view of the risk, and that's really measuring kind of it's gauging how much liquidity there is that's driving this bull market upwards, relative to the momentum moving upwards. And so as around here, which was January 2026, the momentum was still going up, but the liquidity wasn't quite there. You could see that also with this breaking down. And so effectively, we are very much in the hot zone right now. It's very much a hot zone. Like generally, we can run 12 months or so before the momentum runs out. where the liquidity behind it is waning. So that's it in a nutshell. I hold all of this very lightly because investment behavior can change. We can see flows come in higher and higher. There's no law that says it cannot, but historically, the trend is downwards. And it's unusual for us to see something that breaks trend, but I'm not saying it won't happen. At this point, it's shaping up like a March sort of reversal into a bear market, in my view, unless we see flows come in. That's it.
Just to complete the picture, Willy, because I think you had a very good point during the lesson that we talked, which was understanding as well let's say the liquidity profile that we were seeing on Ethereum Solana. How does that look like right now? Obviously, these things are lagging because Bitcoin is leading the way, especially as flows come back in. But the reason I ask is that we did see, especially on January 5th, and I'll get into that in a bit, we did see an increase in activity in terms of value locked in pump fund and some of these other mean-related, let's say, risk-taking endeavors, right, in the space. Does that get reflected in your analysis?
The last time I checked this, there wasn't too much signal coming from the flows, but let me refresh this now to see whether or not we're getting. So the silver is Ethereum, and Ethereum made an early recovery here before Bitcoin recovered. And let's have a look at Solana, which will be the blue. So yeah, the alts are recovering, and they've been in a recovery trend since the end of November, whereas unusually Bitcoin's recovering late. If anything, I think that because these flows have been increasing and now the flows from Bitcoin are now making that recovery a little bit late. Bitcoin being the foundation there, with those flows being positive and Bitcoin holding its support without breaking down with increasing flows and this recovery in altcoins, then I would have expected altcoins to start to really mount an attack right now, which aligns with Henrik's view on Ethereum, just from a flow perspective.
Yeah, it seems more end of cycle, meaning that you do have probably a predominant part of that liquidity flowing directly into Bitcoin beta alternatives, which are obviously Ethereum is one of them. And that obviously has some sort of flywheel into the rest of the market. So to Henrik's point, I definitely see that as well. But it's interesting that you see the recovery faster. Yeah. Very, very interesting.
Yeah, well, one of the things that is a end of bull market sign is when you see Bitcoin start to deteriorate, which you see here, and recovery in alts. So you're getting alts, leading alts to be strengthening in flows and Bitcoin to be declining. That divergence is usually seen at the end where people are rotating into the higher risk asset at the expense of Bitcoin. All the earlier times in the bull market, you see that they move in unison. And with Bitcoin suddenly putting in a sort of a floor structure here, then I think we can get this final pump.
Could I ask another question, maybe incorporating some of Henrik's points that he made at the beginning, before we go a little bit deeper into Hawkeye as well, to kind of look at the alt side of the equation? How do you guys see this narrative that we've been in a QT or predominantly QT environment, right, since the end of the last bull market, let's say end of 21, or let's say October, November 21, and that we've only really seen kind of the first innings of a quantitative easing type of environment since, let's say, December, right? And you've had a growing or a rising Bitcoin through that time in a real alt season, which is exactly what you would expect in a liquidity constrained environment, and an environment where Bitcoin actually becomes let's say, a macro asset in its own right, which also would mean that it actually absorbs capital from other areas, not just the excess capital that gets created from quantitative easing, which has been the case over the last, let's say, 10 to 12 years, and has been consistent with let's say, the 4-year political cycle, 4-year general, let's say, fiscal stimulus or monetary stimulus cycle, which this time seems to be different. I don't know, Henrik, maybe you and I have had quite a few discussions on this, right?
I'm not really sure what to say. I mean, there's things there are many reasons why we see the kind of development that we do, and this is where for me it becomes a little too nitty gritty kind of thing, and having to speculate about Bitcoin by itself. For me, it's part of a bigger picture, and Bitcoin. Yes, there are some of these dynamics, and I think you know more of these than I do. 100%. So you're probably right. I would say you're probably right on your perspective there, Jan. I don't have much to add to it, honestly.
Yeah, my view is that, when I look, I'm not an expert in this whole global macro side of things. My job is very simple, and it's just to measure how much of the flows come into Bitcoin. And what I'm seeing is it has been flowing, but it is breaking down now. And as we ease, I think that one explanation of easing is, you ease because the economy's weak. If the economy's weak, you ease, and if it's weak, Bitcoin tends to lead. It leads. The top equities follows, and that would play into the picture I'm seeing right now with Bitcoin's looking to top earlier this year. And if we do get a pullback in 2026, that would fit. That's it. I do think that there is something to be said with the gold price going through the moon. And I do think that there is a run to safe haven assets right now. We may be approaching, Dalio's long-term debt cycle, the end of it. And so, and I don't think Bitcoin's ready to be the safe haven yet. It still trades too risk on, and there's risks around quantum compute over the next 5 to 10 years that's where the safe haven is needed. So those are my views. In terms of quantitative tightening and easing, it's not really my wheelhouse, but yeah.
Yeah, it seems like whatever is happening right now is definitely mechanically different, which, it's definitely not following the traditional 4-year cycle, right? I think for any intents and purposes, even if this is kind of another relief and then, a continuation of a bear market or a blow off top, like Henrik is saying, as the opposite, let's say the opposite extreme case, we are changing. It's clear that we are transitioning to a completely new paradigm, right? It is acting like a macro asset. And I think it's going to be interesting to see how that develops. Maybe to take it a step back, to follow up on what you were talking about before on alts. There's a couple of interesting things that we're seeing right now. I would start maybe with the crypto side of the equation, at least from a structural kind of high level perspective. The interesting thing with what we're going through right now, it's clearly a longer correction, which from a structural strategic type of perspective, to give you kind of a relative perspective, we have not seen a lull of the sorts since October 10th, since 22. And to be more specific, the March, April, May phase of 22, basically when we had the brunt of the correction, right? Where I think we had like within a couple of days, like 30-40% moves in Bitcoin and Ethereum. And the guiding lights to be able to understand the sort of, let's say, environment that we're in this case, negative environment, is the algo trend framework, right? Which has been out, to be more specific, since October 10th for 94 days now, with a small little blip that you see here, that was driven by a massive rotation from, or probably repositioning from a larger set of players. And it does tell us that there's something coming, but it's not clear yet what that is, right? I do think that there's a relief rally at the minimum within the next couple of weeks. And I think your liquidity picture really tends to reinforce that as well. So not only what Henrik said on the medium to long-term view with, let's say, the structural Elliott wave extensions, but also the liquidity seems to reinforce this. At the same time, also our signal or our algo trend strategy, right? It tells us that something is afoot in terms of momentum. What's interesting though, if you go back to 2022, the longest period that the algo trend was out was 96 days. So we're right now matching pretty much that period. And that kind of tells us two things. One, how strong and how vicious October 10th was in terms of liquidity implications, in terms of actual plumbing and infrastructure from the market making side, right? You're seeing a lot of these Bart Simpsons, us trading the range pretty much between, let's say, that 86, 87, all the way to the 94K area, right? And that's usually a sign of obviously illiquidity, but more importantly, lack of market maker presence that add liquidity to the order book, right? So I think there's a lot of 2019 type vibes that I'm getting as well. And what's interesting within that context to look at as well is the actual, let's say, profit and, let's say, positioning within, or let's say profit taking the positioning within the system. And that's, for those of you that have been with us for a while, you know that we look at the, let's say, the structural profit loss. So how sensitive people are to taking chips off the table or taking profits when things don't look so great. We measure that with our risk off signal. And what's interesting here is that it's having a very similar pattern to what we had in the earlier parts of 2025, after the, let's say, the tariff sell-off or the global risk off sell-off that we had in the earlier months of 2025, we're getting a similar type of pattern where we had kind of these two, you see that it kind of went from a very stable environment to a very risky environment, kind of as soon as it goes into that red area. And it basically retested or tried to basically confirm a bottom for a potential reversal 2 different times, where on the third attempt, it actually managed to break through that 90, back then I think it was an 85 or 84K price area. What we're doing right now is actually retesting that critical 94, 95K area on the top side, right? So the resistance is right there at about 94.7. At least in terms of how we calculate it. And that's important to note because it has tried on 2 different occasions, it's tried to actually test that area, right? The first time on the way down, when it went through the 100K area. And the second one was about a week ago, roughly, on that January 5th, which coincidentally was also the time where the algo trend started to trigger again. So the quantitative signal that we have that measures momentum, right? Momentum being very important because Bitcoin is a very momentum-driven asset, right? It's like a juggernaut. Once it starts rolling, it just keeps going until it doesn't. We haven't really seen that sort of effect in about 94 days, which is significant, right? Historically speaking, that is a long, long time. So something is changing. We're still obviously very, very curious to see what that is in terms of actual, let's say, price development in Bitcoin, but it is, to Willy's point, lagging. And we're seeing that as well if you look at to isolate from, let's say, our alert system here. We have 2 things that got flagged about a week and a half. So let's say XMR that got flagged about a week ago, obviously with gold as well. We had Golem, which was very interesting, and we had Dash now confirmed that as well. So there's a resurgence of privacy tokens very clearly. To give you a little bit of a better picture, we have Monero and Dash here. Monero is the blue curve, Dash is the yellow curve. So you see very clearly that, to look at Monero first, about in that, let's say the January 5th area, that I was mentioning before, we had the first innings of that rotation into alts that was a lot stronger, especially into the meme and privacy token narrative, which I think was very significant and hadn't really been seen since the later stages, let's say, of December, and also the run-up of October, November, December with Zcash, sorry. And we were seeing a resurgence of that, which is very interesting. And if you look at here, Impulse Framework was able to identify the trigger at around, let's say, $460 on Monero, and it's been going off ever since. So there's a clear rotation of capital into some of these, let's say, staples, or let's say basic privacy stable or blue chip tokens. We're seeing the second one now with Dash that triggered at around $40. So same idea, right? We're seeing this bigger spike in volume and then a follow through with momentum as well. So this is not just a blob. It seems to be that there's a repositioning into these narratives. And this is kind of simultaneously being kind of coinciding with a slightly weaker Bitcoin. So what you would want to see to kind of understand when a breakthrough is actually more likely to happen, going back to some of the discussions that we had earlier or later in the later parts of last year, is that we want to see things consolidate back into the staples, right? So we're talking Bitcoin and Ethereum. And the reason for that is that we need a lot of energy to overcome that 94, 95K area, which seems to be a massively important, basically volume threshold, price threshold, and also cost basis threshold, right? So that's an area where a lot of people took profits or cut their losses, right, on the way down. And they're also defending on the way up, in part due to accumulation, but also because that's let's say the cost basis that they sold at. What we would want to see more is a consolidation back into Bitcoin. So I'll use let's say the August to October 2024 phase to kind of give a parallel where we saw similar type of action. We had a lot of repositioning, right? After a major correction. If you guys remember August 3rd all the way to about 15. We had major volatile bottoming phase in 2024. And out of the ashes of that bottoming phase, we had a repositioning on the, let's say, on the portfolio positioning level, right? Where people started to reposition to Ethereum. And back then also Solana, Sui, right, was another one that was very popular. And you had a lot of froth. So a lot of movement and a lot of interchanging strength, right? Sometimes it was small caps, sometimes mid caps, sometimes large caps. We're seeing a very similar type of dynamic right now, where it's not clear who's actually taking the lead in terms of strength, which is an issue because you're basically distributing that energy across multiple different tokens instead of concentrating it into one major flagship token, let's say Bitcoin or Ethereum, that then manages with that energy to actually punch through that resistance, which right now is at 94, 95K. So what we would want to see for a clear signal of that sort is a reconsolidation into Bitcoin, as it was the case in October, November of 24, or a reconsolidation into Ethereum, like we saw basically Bitcoin and then Ethereum, like we saw in April, let's say the April, May phase of 2025, right? So what I would expect next is a reconsolidation to Bitcoin that gains momentum, gains strength. Once you start pushing over the 94, 95K area, there's really not a lot of resistance all the way up to 102. And that's when the actual longer term positioning starts happening, right? So some of these larger trend followers start moving back in, and that creates a flywheel that could potentially push us beyond even 107 very quickly, right? If that happens in a very strong way and you get external capital to follow through, you get a situation like the one that Henrik was mentioning before, where you actually don't only have a repositioning within, let's say, the crypto space, but also external capital being allocated, let's say, or being driven away from gold and silver and equities, maybe especially small cap equities, back into Bitcoin. So that's basically what we're waiting for right now. Given the time, what do you guys think, Willy, Henrik? Should we go with some questions?
What crypto themes do you forecast accelerating as most quickly in the next run? What are the themes in the next run?
So I think because you have a lot of institutional presence, I would say that it's a lot of tokens that actually generate revenue. So revenue is going to be one of the key things that define sustainability and actual value, right? Now that we're kind of going into this maturity phase of the asset class. But I also think that the old narratives are probably going to be relevant as well. The ones that were relevant in 25, 24, like memes, when things really go off, when everybody's taking excessive risk, memes are going to come back full force. And I also think because of the infrastructure discussions you have, the layer one, layer two discussions are always very prevalent, with SUI being one of those, let's say, at the forefront. And then also ZK, right? So anything that is privacy related is going to be at the forefront as well. Not sure, Willy, if you have anything to add to that.
I think that tokenization of equities is going to be something, I think it's like moving into the mainstream. Like I think that there's a good push to get, Solana backing or securitizing a lot of equities. So that type of stuff, I think also quantum is a worry. Maybe that's more towards the Bitcoin side of things, because you want a very robust like store of value. And I think even though we might be many, many years out, I think the market worries about it is going to build up over the next 5 years. And that may even be impacting price already.
Yes.
Okay,
absolutely.
Should we move on to the next one?
Yeah.
Interesting divergence between Willy's bearish long-term outlook and what we perceive to be ever-increasing strength in long-term fundamentals. I guess it's a show me point of view, which is valid. I wonder if Willy sees that as well. Yeah, I mean, we've got a lot of long-term fundamental news, right? I see that. And I mean, if you call that fundamentals, the fact is the flows aren't coming in. And so that's very much what I say. Show me the investors coming in, and they may come in later, but when you get positive news and the price doesn't move, the flows don't come in, it's usually a confirmation of a bearish trend. Yeah, yeah, show me. We measure investor flow, not the narrative or legislation. Until the investors come in, it doesn't mean anything in terms of how it's going to impact price. Willy, you are thinking of investing in Bitcoin over how are you thinking about investing in Bitcoin over the next year? Are you you previously said the previous CFC adoption will move price as we go beyond 1 billion users, and you're invested 40%-ish in Bitcoin. Is this your position? I don't know if I've ever divulged my position. I make that a point, not to divulge what my position is, but I have sold. I sold in September because it did not. There was a risk reward. I thought it could go higher, sure, but the liquidity was breaking down, and if it went higher, I didn't think it was worth the risk of it not, if it broke down, but it could have been the top. We were approaching the top with liquidity breakdown. I felt like risk reward, it was better to take money off the table. So I scaled out very quickly, and then the last bit I scaled out slowly. And I'm thinking that I'm just going to wait until the dust settles. I mean, this will be my fourth bear market. I'm always late into the bear before selling, and then I'm late into the bull until it's confirmed. And this time I was early, and mainly because the models are a lot better this time. And, remember, this is like almost the 10th year it is the 10th year of these on-chain models. And this cycle, it's a lot more maturity on these models. I'm just going to wait for the dust to clear, and then I think I'll get exposure back in through instrument. For me, it's not going to be self-custody. That's mainly for operational security reasons, and also I'm investing into the ecosystem. So I'm very much an advocate still for the space. So regarding adoption, I haven't followed that very closely of the last year. I think River came out with a report that retail hasn't really expanded too much this cycle, and that is a worry. And I need to get their data and put it onto my tracking. I've got a chart of all the data of each survey that's been credible on how much adoption there has been on the asset class. So. But I have seen it slow recently. So yeah, that's a problem.
I think generally with all the different fundamental markers that we track, there's been a fairly significant, I wouldn't say massive, but fairly significant reduction in market participants, which is, by the way, also a sign of a major bottom, right? Where you get a larger part of the ecosystem that gets disenfranchised. They are unhappy. They rotate their focus, their attention somewhere else, and then they tend to come back full force. So that is, it is a situation that needs to be monitored very, very closely. I think that is where on-chain data is very fundamentally important.
I suspect that Bitcoin's not like going to the moon like it used to, and with that kind of outperformance we had in the early days, it was perfect for retail. And
Yes.
because the returns have been so low, they're now in the order of not much different from equities. It hasn't attracted retail who like to have an exciting asset. And actually, if you look at where those returns started to roll over, it was really the last cycle. And that was exactly when the futures market started to get large open interest and volume. And you actually notice in the chart, it rolled over. We never see Bitcoin roll over. We go exponential, then pop. And that's a sign of no one able to short it, right? With the futures markets, you can front some cash. Hedge funds can front their billions and then sell the asset into the market through synthetics without actually owning Bitcoin. So it has dampened things, and I do think that once you start to dampen, like you can short this instrument, you dampen the returns, and that has a follow-on impact to retail not coming in. Whether we like it or not, usually these adoption curves are run up by bubbles. We saw that in the dot-com bubble, and all the infrastructure was built out. We saw that from 2009 all the way up to 2017, and the next wave, it rolled over with the paper instruments. And I sometimes think we would be well over $1 million today if futures hadn't come in. I've got a top model that tracked the behavior of what a top looks like when it goes exponential. When it was just spot only markets, we would be way multiple trillion, not 2 trillion, maybe even closer to 10 trillion, 10 trillion or above without that sort of paper instrument, in my opinion.
I think it postpones inevitable, right? I mean, you kind of see the first innings of that with gold, right? Where it's just been suppressed for a very, very, very long period of time. But at some point, the rooster comes back home to roost, right? Where it's because of the way that geopolitics, the abuse of the financial system plays out, that things converge back to what value really looks like at the end, right? Which is really the spot market. It's where the true, let's say, value of the underlying asset truly lies, right? Papers tend to your point, they tend to dampen it. They increase the tradable volume that you can access to be able to get, a foothold into that asset class. But it doesn't change inevitable outcome. It just postpones it to some extent. But at the same time,
yeah, I don't think that's the case. I actually think that because you've got synthetics, right? Once you've got a synthetic, you can, like the limited supply is not limited anymore, because look, if you wanted to buy 42 million Bitcoin exposure, you can do that through synthetics, just as long as there's enough fiat in the world to collateralize it on the other end, and someone's always going to be able to do that for you. So I think once paper markets are in, that's going to start to really dampen things down, and it becomes this momentum. Actually, like there's suddenly a lot more of the unit to move than you originally had. A lot more capital to move it, and gold has had, it's 6,000 years of price discovery before paper instruments came in. Bitcoin had paper instruments sub $1 trillion, significantly below $1 trillion, and it's been really heavily been hampered thanks to, the SEC banning spot ETFs from as early as 2014. They really had it in for Bitcoin, holding that kind of adoption back on spot, whilst they okayed the futures markets well before the spot. It's yeah. Anyway.
Yeah, no, that does make sense. Let's see. Next question, Cedric Alfonso.
Thank you for sharing Bitcoin, Ethereum, and Solana flows. 2 questions. Do you have similar data on stablecoins? Are stablecoins taking market share from Bitcoin? I haven't tracked that. It's probably a very good idea. Bear in mind that the biggest race in town is Tether by a long shot. Not many people realize that around 50%, I think even more than 50% of the AUM of Tether is not for trading crypto. It's actually to facilitate trade and to bank, to provide banking rails to Latin America. And so, so would be tracking an adoption of, the other business that Tether has. Hi, Henrik. Do you see, where do you see the top for Nifty? And when do you expect it approximately?
Let's see what we have for the Nifty. I mean, I think you're going to see like what you saw in 2007 and 8 that the Nifty and maybe also other markets in Asia could potentially top out a little later than we see in the stock market in the US. So I wouldn't be surprised to see that we go further into, again, I don't want to put timeline too much on it because I can see also people say, yeah, but you said, I never said it's a specific time. I said my thesis is that we have at a point. But as you can see, the development in the economy is going exactly in this direction. So it's just about when we see that it's actually, rolling over to the right degree. So the when question, guys, it's where and what should we be watching out for when we get there. For the Nifty, I would say we should see at least 30,000, maybe 31, 32,000 even on the Nifty before we get there. And I would expect that to top out one month later than what we're going to see with the S&P and the NASDAQ, which, by the way, is in price maybe far from it, but I don't think it'll take a lot of time, to be honest. So hope that helped.
Okay, this is, I think, for Henrik and maybe Yann as well. If they debase the currency by 25% like they did in 2020, would that prevent a stock market crash?
How do we answer that? I think people have this idea that if you just throw enough money on the stock market, then it will do well. But we have to think more than just that. We have to understand what there are, first consequence and the secondary and the third tertiary or whatever we call that. And then you'll see that of course, if they come in, when they come in, because they will at some point, but they will not do that now. You can see how hawkish they are, even though there's no inflation in the system. There is the core CPI was down to 2.6%, and we have a labor market which is really declining quite strongly here on the non-farm payroll. So we have exactly a situation where the Fed should have been intervening much more than what they are right now. So they are really hawkish. They have gotten scared from the situation that they had this 9.1 inflation spike. So the Fed will come in, but we're going to see quite dramatic development before that happens. And when they do, of course, it's going to create a bounce in the market. The question will be, what is going to happen with QE that comes into the market? See, people have this assumption that if you send QE into the market, everything is going to be fine. And then they'll just, make market go up again. See, that is not, you can ask yourself, why didn't we do that in the 70s then? Thing was, if you did that in the 70s, you've got inflation. If you get inflation, you crush the consumer even more. And then the stock market will crash even more. So that we have to understand there can be a shift of regimes, as it's called. And the shift now is inflation has been reintroduced to the system, to people, and that psychological change is going to change the whole effect and the consequence of when they come in. So the question is, yes, they're not just going to keep expanding it because they can't, but they will create a bounce when they come in. That's not now, guys, because the market is still going up. So there's no need for that right now. But when they do, when we see the market rolling over and we see the economy really falling into to what looks like a recession, then they will create the bounce. But they cannot inflate the market indefinitely. It's not possible. I know everybody thinks that's the case, but they cannot. You can have that the M2 is rising and expanding. You can look to 2007, you can look to 2001 and see we have exactly that. And yet again, you'll have that the market can crash quite substantially. So the thing is, they will create a bounce, but it will not be enough to save the economy and hence not be enough to save the market.
Okay, yeah. I think we only got time for one question. Okay, so I'm just going to Chris Ward, which is quite an interesting one. He said during October, November, Henrik thought the crash would come in fourth quarter. Willy and Yann thought it would be first quarter 2026. Where do you stand now, Henrik? Your S&P target is now 8,200. This has increased from 6,800 last year. Do you suspect that you will increase the target again? And how long do you think it will take to get to your target? Ultimately, are you guys very confident on the crash soon? Thanks.
As I said before, again, when I do an indication of a timeline, it's because everybody asks for that. What I've always said, and also with what I've been pointing out in the Substack article, saying ask about where and what, not about when. Where is the levels we can see right now? So when back in 2022, everybody was saying we were having we were going lower. And I don't know if you remember the situation. I do it vividly. I said 6,100 at that time. And people saying I was crazy. We were at 3,500. As we were moving up, I could start seeing that the time that, passed and the development of things were not really fitting the 6,100. So I raised it to 6,800. And I said, well, this could be the target. Remember, I was long all along. I was long from 3,500 to up to 6,100 to 6,500 to 6,800. And now I'm saying 82. Will I increase it again? I'll say, let's see. As you saw before, the coincident indicator or the non-farm payrolls, the real economy is definitely rolling over now. And we have so we could easily have been in a recession at this point here, as you could also see from the numbers that I showed you, easily. So will we have to extend it again? We'll have to see. Depends on what develops. But I know what I'll be looking for. And that is a cross-border confirmation from, you saw also the Singapore index, from indices around the world saying, now we are at the top. We are seeing deterioration. Willy is into this on the liquidity side from Bitcoin, and I see the exact same on Bitcoin, and I see the exact same also on indices around the world. We have deterioration in the structural setup, but we need still to see where that tops out. Right now, my guess is 8,200. Let's see when we get there, but I think it's going to be a crazy run, the final run up to it.
Yeah, I think I was the one that said around October, and I thought Henrik, you and Yann thought 2026, but I was specifically thinking Bitcoin because that's my read, and maybe that's still the case. October the 6th or something is being the current high. If we may even, I kind of think we might get a head and shoulders, even a classical head and shoulders pattern, go up to above 100. But certainly that doesn't mean the S&P doesn't rip much higher. So two different patterns here, two different markets. Okay, that brings us to the top of the hour. Shall we close it?
Yeah, we can. I think that, so first time I think we've actually made it within the hour. So that's good. Getting more efficient.
Yeah.
Like always, if you have any questions about how to get access to any information that was discussed, just reach out. And you can reach out over Twitter, also to our Swissblock email. Thanks, guys.
Thanks for attending, everybody.
Thank you.
Bye-bye.
Bye-bye.